so I guess we didn't really discuss any of this beforehand, but so I own a hotel, just one, and it's not a franchise. It's in a really small town, so we've got some struggles, but there's 3 of us. So I was mailing for single families. This guy was like, well, I'll sell it to you, but I've got all this other stuff I'd like to let go of. So it's 2 small apartments and then a 40-unit hotel with like pool, hot tub, whatever. And we structured it to where one of the 3 of us gets a 7% management fee off the top, and he takes all the operation stuff. And that's been so nice because I'd lose my mind if I had to manage that thing. It's such a mess.
Yeah, it's complicated. It's really complicated.
Yeah. And you got so much more just nuanced stuff that you have to worry about with the hospitality business. Like, you have an apartment complex and your tenant hates you and they move out and nobody cares, but you have a hotel and someone has a bad experience. They leave you a 1-star review, and that is just no bueno. So it's an interesting gig.
Yeah. There's a lot to love about it though. So, I mean, I always kind of correlate this to multifamily because that's what most people know. And I did operate in that space a little bit. So I understand the space and I understand the underwriting and numbers and everything. I understand the processes. But with hotels, the thing is that, every month there's this report that's put out called a STAR report. I can't recall what the acronym stands for, but basically it tells you how your hotel performed, what was the occupancy rate, the revenue per available room, your average daily rate, what that was for the last 30 days, how it compared to the last 12, the last year, what was your trailing 3 and your trailing 12 and year to date. But not only does it do that for your hotel, it does it for the entire comp set, the entire competition segment. Yeah. So with the comp set, all the numbers on the comp set are there, right? So, it gives us a clear picture of what the capacity is. So when we're looking at a hotel, it doesn't necessarily have to be a foreclosure. It doesn't even necessarily have to be marketed as distressed. It's profitable. It's marketed as profitable. This is the price that it's valued at based on the income that it receives. But then you look at that report and you realize, you can see that maybe its occupancy was the same or better, but its average daily rate was less, right? So that's where a lot of your opportunity is. So then you got to ask yourself a couple questions. Why is that, right? Is it because of condition? Because that costs money, right? Capital expense. But if it's management, that costs almost no money, and it's something easy to fix. Really easy to fix. They've done. David's been doing it for 30 years, and so it's just amazing how complacency and poor management factor into the hospitality space. And it's like that with, any kind of commercial real estate, right? It's values based off of profit, or off of income. So if the income's low, you're getting a good deal, you're getting a deal. And a lot of times that puts them at a negative, that puts them at a disadvantage in the negotiation because they know it's underperforming, right? And they look at it as this big hurdle that's going to have that people are going to have to come over. And a lot of people look at it as this massive hurdle. 30 to 45 days, and that's, it's in revenue management, 30 to 45 days, and we fix revenue.
That's awesome. That's a quick turn.
Yeah, it's really fast.
Especially when you can just pause that and highlight how fast that is. If you're doing multifamily, the only 2 ways you raise rent are, 1, renovations, which you mentioned on the hotel. If it's distressed, right, that's expensive. So that could be either one. But the other is when someone moves out. With an apartment complex, you could have your thumb up your butt waiting 9 months for somebody's lease to come up. And then finally you can bring it up to market rent, even if you don't have to update it. Whereas with a hotel, most of those people are going to be gone by the end of the week. So ta-da.
Right. Exactly. Oh man, exactly. And, and like one of the other like really interesting things about it is when you're assessing your capital expenses, right, for a multifamily or any other commercial asset for that matter, you're doing the assessment, right? It's you doing that assessment, saying, hey, these items need to be fixed, right? And you're taking on the ownership and the responsibility of the capital improvement for an impact that you want, right? That you desire. Maybe it works out the way you want to. Maybe it doesn't. Maybe you go over budget. Maybe you don't. With hotels, especially if it's a franchise, they issue out a report. They go in and do this massive inspection and then issue a report called a property improvement plan. And if you want their hotel, you have to agree to that plan. And it tells you everything that needs to be improved and the timeline. And the timeline is not necessarily real short. And so you're able to negotiate the timeline on certain items. So it takes all the guesswork out. David just hands that to his improvement guys. They go source it and say, hey, this is how much it's going to cost. And, we throw that into the race.
That's awesome.
Yeah, it makes it real simple.
Do you, what's your like buying criteria? Like what class of hotel are you guys operating in?
Sure. So, great question. The opportunity that is out there is so vast, virtually unlimited in the hotel space. There was this incredible report, and I'm going to get to your answer. There's this incredible report put out by hotelmanagement.net in August of 2020. And basically what it said is, it took a look at the impact of COVID in the hospitality space, right? And so that impact to COVID, they assessed that 80% of all hotel mortgages were in jeopardy of default, with an expectation of 50% of all hotel mortgages would go into foreclosure proceedings in the coming year, right? And a lot of that is what occurred. So just because you see a hotel that's open and operating doesn't necessarily mean it's not bank owned or franchise owned.
Yeah, we had a couple, at least one that I know of that went down and got demoed to build something else here in town.
Exactly. Yeah. We're starting to see an interesting tactic where, multifamily people are shifting into the hospitality space and doing conversions into, and there's a lot of really great benefit to that. Just depends on, there's a niche for it. But so we would get these, David has the capability of managing all the way up to, 5-star resorts with all the bells and whistles, all the way down to, boutique bed and breakfast. So he has that range, and with an experience with every franchise. So there's really no limit to what we can do and what we can take. Really, the limit right now is us. It's how much capital are we able to raise? What is the size of our network? And what portion of our network is investing with us? And so right now, our sweet spot is within that, somewhere between like $1 and $3 million raise. With typically between, for accredited investors, it's typically between $50,000 and $100,000 for a minimum commitment.
Yeah. So that puts you at what, 5 to 15-ish for purchase power?
Yeah, about that. So yeah, we're picking one up for 4.4, but the exit's going to be about 9.5. And then we picked one up for 3. So we're getting a lot in that sweet spot around that 3 to 5 range. And there, so typically that's your limited service, your economy class kind of hotel. But there's a lot of great opportunity out there that we're really trying to shift into that's in the select service, especially around Branson, Missouri. Oh my God, Branson was just eviscerated during COVID.
Really?
And,
so
yeah,
I'm in Springfield, about 45 minutes north.
Oh man, like every hotel in Branson is for sale right now.
Oh, I'm sure. Yeah. They got decimated by COVID. Very cheap. Old people Vegas.
Cheap. Yeah, that's the Midwest Riviera, right?
Yeah. Oh, that's funny. Yeah, Branson's an interesting beast, but yeah, that's That's cool. Yeah. Anyway, so didn't mean to derail you there.
Yeah, no, that's great. So I mean, there's just that much out there, and the thing is there's not a lot of competition. So if you go off the rule of supply and demand, right? Multifamily has very limited supply and a ton of demand, massive ton of demand, and so it makes it really competitive in that space to get, and that's why you see that cap rate compression, right? In the hotel space, they don't necessarily go off a cap rate; they go off of gross revenue multiples, and so you'll see. You got to identify who are you competing with, right? All the you see all the assets, all the supply. Who's the competition, right? And so, and who buys hotels, right? So it's institutional investing, like publicly traded REITs. That's your big money. They don't buy value add, right? They buy stable core plus, what they call it, stable assets. And, because they want a stable return for their investors with moderate growth. So that's the end user, right? On what we're doing. Then you have, some multifamily people that are coming in and doing conversions. Well, it only really makes sense for them to do that with a severely distressed asset, or something that has lost its flag or something like that, because it costs too much money to divest it and then reimagine it. And so the opportunity there is in like these abandoned hotels in these towns that need housing, right? And so governments incentivize them. So there's a lot of great opportunity there, but they're not a competitor to us because that's not what we're buying. And then, so franchises want you to have franchise experience to be able to sell you a franchise. And the banks want that too, to be able to assume the risk. So, and then a lot of those people that had been competitive just got their teeth kicked in the last 2 years from the impact of COVID. So they're not competing. So really, we can pull, we have so much, we can do so much. The opportunity right now is so good. Best time in generation to get into hospitality, but it's so good in hospitality that when we structure, we take 49% of a hotel, right? Raise the down payment money. And that's the investment. And then from that 49%, we won't even send it to our phase 2 underwriting if I can't identify 20% or better internal rate of return for the limited partners, for the investors. So even after all of that, cutting out 49%, taking our GP stake and doing all the whatever fees that have to be affiliated with it, we still find 20%. I can find it all day long.